Before we begin, a quick but important disclaimer. This presentation is for educational and informational purposes only. I am not a licensed financial advisor or insurance agent. The contents of this video should not be taken as legal, financial, or insurance advice. Every individual's situation is unique, so please consult with a qualified and licensed professional before making any financial decisions. The average American driver overpays for car insurance by more than $400 every single year. Let that sink in. $400. That's a new set of premium tires. That's a weekend trip you didn't take. That's a car payment. For millions of us, it's money we're just lighting on fire, handing it over to a massive corporation for the exact same product we could be getting for hundreds of dollars less. And the worst part? The system is designed that way. It's built on complexity, confusion, and our own loyalty. But today that ends. By the end of this video, you will have a simple step-by-step blueprint to navigate the car insurance maze and find the absolute best rate for the coverage you actually need. We are going to demystify the jargon, expose the pricing tricks, and turn you into the kind of savvy shopper that insurance companies secretly hate. You will never look at your insurance bill the same way again. Let's start by destroying the single biggest myth about car insurance, a myth that costs people fortunes. The idea that all insurance is basically the same, so I'll just pick a name I know. This is catastrophically wrong. The price difference for the exact same driver with the exact same car and the exact same coverage levels can be staggering. We're not talking about a $10 or $20 difference per month. We're talking about potentially $1,000 or more per year. Imagine a 30-year-old driver in Dallas, Texas with a clean record and a 2021 Honda Accord. Company A might quote them $1,800 a year. Company B, for the identical policy, might quote them $950. Company C might come in at $1,200. Why? Because every single insurance company has its own secret algorithm, its own secret sauce for calculating risk. They all weigh factors differently. One company might heavily penalize you for living in a specific zip code, while another doesn't care as much but hates that you have a two-door car. One might love your credit score, while another gives more weight to your continuous insurance history. Their goal isn't to give you the fairest price. Their goal is to find customers who fit their perfect, most profitable risk profile. If you're not that customer for them, they'll give you an astronomically high quote, hoping you don't know any better and just pay it. Your job, and what I'm going to teach you how to do, is to find the company whose secret algorithm loves you. So how do we do it? We start with the foundation. You cannot compare quotes effectively if you don't know what you're actually comparing. Clicking state minimum and hoping for the best is like building a house with toothpicks. It's the single most common and dangerous mistake people make. So, before we ever look at a single quote, we have to become an expert on our own needs. We need to build our ideal policy on paper first. Let's break down the 6 core building blocks of any auto insurance policy. I promise to make this simple. First, and most important, is liability coverage. This is the one part of insurance that is legally required in almost every state. Liability does not cover you. It does not cover your car. Liability covers the other guy. It pays for the damage you cause to other people and their property if an accident is your fault. It's broken into 2 parts: bodily injury liability and property damage liability. When you see numbers like 25/50/25, that's what they're talking about. The first number is the maximum. In thousands, the policy will pay for one person's injuries. The second number is the max for all injuries in a single accident. And the third is the max for property damage like their car or a fence you might have hit. Now, here's the critical part. Your state's minimum requirement is a financial trap. It is dangerously low. A state minimum might be $25,000 for property damage. What happens when you skid on ice and hit a brand new $60,000 Tesla? You pay the first $25,000 through your insurance, and then the other driver's insurance company comes after you personally for the remaining $35,000. They can garnish your wages, put a lien on your house, and ruin your financial future over one bad moment. The cost to increase your liability limits from the pathetic state minimum to a truly protective level like 100/300/100 is often just a few dollars more a month. It is the single best bargain in the entire insurance world. Okay, that's coverage for the other guy. What about you? That brings us to building blocks 2 and 3, collision and comprehensive. Collision coverage is simple. It pays to fix or replace your car if you hit something. Another car, a pole, a guardrail, and it's your fault. It's what covers your vehicle in a classic fender bender. Comprehensive coverage is for almost everything else. Think of it as the acts of God and chaos coverage. A tree branch falls on your car during a storm. A deer jumps out in front of you. Your car is stolen. Hail turns your hood into a golf ball. Vandals break your window. All of that is comprehensive. For both collision and comprehensive, you choose a deductible. That's the amount of money you have to pay out of pocket before the insurance company pays a dime. A common deductible is $500 or $1,000. The higher your deductible, the lower your monthly premium will be. If you have a brand new or expensive car, you absolutely need these coverages. But if you're driving a 15-year-old beater worth $2,000, and your deductible is $1,000, paying for collision and comprehensive might not make financial sense. You might pay more in premiums over a year than the car is even worth. Next up, building block number 4, and this one is crucial. Uninsured and underinsured motorist coverage. Let's be honest, there are a lot of irresponsible people out there. National statistics show that as many as 1 in 8 drivers on the road has no insurance at all. If one of them hits you and puts you in the hospital, their non-existent insurance isn't going to pay your medical bills. That's where uninsured motorist coverage saves you. It steps in and acts like the other driver's insurance, covering your injuries and lost wages. Underinsured coverage is similar. It kicks in when the at-fault driver has insurance, but their pathetic state minimum policy isn't enough to cover your serious injuries. Do not skip this coverage. It protects you from the recklessness of others. Finally, we have medical payments, often called MedPay, or in some states personal injury protection or PIP. This is another layer of protection for you and your passengers. It helps pay for your medical bills after an accident, regardless of who was at fault. It's designed to get you immediate medical care without waiting for the insurance companies to fight over who is to blame. In some no-fault states, this coverage is mandatory. In others, it's an optional but often inexpensive add-on that provides incredible peace of mind. So let's recap the foundation. Liability to protect your assets from others. Collision and comprehensive to protect your own car. Uninsured motorist to protect you from irresponsible drivers. And MedPay or PIP to cover your immediate medical needs. Your first step, before you even think about getting a quote, is to sit down and decide on your Goldilocks numbers for each of these. Not too low, leaving you exposed. Not too high, making you insurance poor. A great starting point for most people with any assets to protect is what's known as 100/300/100 on liability. For your own car, choose a deductible you can comfortably pay out of pocket tomorrow without panicking. And always get uninsured motorist coverage that matches your liability limits. Write these numbers down. This is your personal policy blueprint. This is the non-negotiable list of coverages you will use to compare every single quote, ensuring you're always comparing apples to apples. Now that you know exactly what coverage you need to be properly protected, you're already ahead of 90% of shoppers. But the next step is where the real savings are found, and it's where most people get lazy and lose hundreds of dollars. It's all about how you present yourself to the insurance companies. The tiny details you provide in your application can swing your quote by 30% or more. And in the next part, I'm going to reveal the 7 critical pieces of information you must have prepared before you fill out a single form, ensuring their secret algorithms see you as the perfect, low-risk customer they're desperate to have. Alright, let's pull back the curtain. Before you even think about typing a company's name into your browser, you need to assemble your digital dossier. This isn't just about having your information ready. It's about crafting the perfect, undeniable profile of a responsible driver. The goal is to make their algorithm light up and say, yes, this is the person we want. Fail to prepare this and you're just another random number likely to get a generic overpriced quote. Succeed and you're on the fast track to the lowest possible rates. So here are the 7 pieces of the puzzle you need to have on your desk, ready to go. First, the obvious, but let's get it out of the way, the personal identifiers. This is your entry ticket. You need the full legal name, date of birth, and driver's license number for every single person in your household who will be driving the vehicle. Not just you. Your spouse, your 16-year-old who just got their permit, your roommate who occasionally borrows the car to get groceries, anyone who might get behind the wheel. Insurers call this rated drivers. If you leave someone off, and they get into an accident, you could be facing a massive denied claim and potentially be dropped by the company for misrepresentation. So gather those licenses. Make a clean list. This is step 1, the foundation. Second, and this is far more important than most people realize, is the vehicle identification number, the VIN. Yes, you need the year, make, and model, but the VIN is the magic key. It's the car's social security number, its fingerprint, its DNA, all rolled into one. That 17-digit code tells the insurance company everything. Not just that you have a 2022 Honda Accord, but that you have the EXL trim package with the advanced driver assist safety features, which qualifies you for a discount. It tells them the engine size, the manufacturing plant, and it allows them to pull a detailed vehicle history report. Without the VIN, you're getting a vague estimate. With the VIN, you're getting a precise quote tailored to your exact car. Go out to your car right now, look at the little metal plate on the driver's side dashboard through the windshield, or check your current insurance card or vehicle registration. Write it down. For every single car you want to insure, this is non-negotiable. Third, it's time for the confession booth. Your complete driving history for the last 5 years. I'm talking about every ticket, every accident, both at fault and not at fault, and every claim you've made. You need the dates and a brief description of what happened. Now, you might be tempted to omit that little fender bender from 3 years ago. You might think, they'll never know about that speeding ticket in another state. Let me be crystal clear. They already know. Before they give you a final price, they will pull 2 reports. One is your motor vehicle report, or MVR, from the DMV. The other is something called a CLUE report, which is like a credit report for your insurance history. It shows every claim you've ever made. Lying or forgetting is the single fastest way to get your quote invalidated, or worse, have your new policy canceled a month later for fraud, leaving you uninsured. Honesty here isn't just the best policy, it's the only policy. By having the list ready, you present the facts up front. It shows you're organized and transparent, 2 traits of a low-risk customer. Fourth, and this is a big one that signals responsibility more than almost anything else, your prior insurance information. You need the name of your current or most recent insurance carrier, your policy number, and most critically, how long you have been continuously insured. A lapse in coverage, even for a day, is a colossal red flag to insurers. It tells their algorithm that you are unpredictable and potentially driving uninsured, which makes you a massive financial risk. If you have been continuously insured with the same company for 3, 5, or 10 years, that's a gold star on your application. It screams stability and loyalty. If you can also find out what your current coverage limits are. For example, 100/300/50 for liability. This gives you a baseline for the quotes you're about to get, which we'll talk about in a moment. So dig out that old policy declaration page. The information on it is pure leverage. Fifth, let's talk about vehicle usage. This is where you paint a picture of your daily life for the algorithm. You need to know 2 things for each car: its primary use and its estimated annual mileage. Primary use is usually broken down into a few categories. Commute means you're driving it to and from work or school. They'll want to know how many days a week and the one-way mileage. Pleasure means you're not using it for a regular commute. It's for errands, weekends, and social use. Business means you're using the car for work-related tasks, like sales calls or visiting job sites. Be honest. Now for the annual mileage. The best way to calculate this is to look at your service records or an old oil change receipt. Note the odometer reading and the date, then do it again a year later. The difference is your annual mileage. Don't just guess or lowball it thinking it will save you money. If you say you drive 5,000 miles a year but get into an accident 40 miles from your house 8 months into your policy, with 8,000 new miles on the odometer, they're going to ask questions. An accurate picture of your usage leads to an accurate and stable price. Sixth, the silent factor that can swing your rates by hundreds of dollars: the garaging address. This is simply the primary address where your car is parked overnight. Usually it's your home address. But if you're a student living away at college, or you park your car at a different location, you need to use that specific address. Why does this matter so much? Because insurance is all about localized risk. Insurers break down the entire country into rating territories, sometimes smaller than a zip code. They have decades of data on the rates of theft, vandalism, accidents, and even weather-related claims in each territory. Parking your car in a quiet, suburban cul-de-sac is a different risk profile than parking it on a busy street in a dense urban center. It's not personal, it's just statistics. You need the exact full address because that single piece of information can be one of the most significant factors in your final premium. Finally, number 7. This is where you take control. You need to have a rough idea of your desired coverage levels. Don't worry, we're going to do a deep dive on this in a later part, but for now, you just need a starting point. Think about the 3 main pillars. 1. Liability. This is the coverage that pays for damage and injuries you cause to other people. It's required by law, and you need to decide if you want the state minimum or something more protective like 100/300/100. 2. Collision. This pays to repair your car if you hit something like another car or a pole. 3. Comprehensive. This pays for your car if it's stolen or damaged by something other than a collision, like hail, a fire, or a deer. For collision and comprehensive, you also need to choose a deductible, the amount you pay out of pocket before the insurance kicks in. Is it $250? $500? $1,000? Having a starting point like, I want 100/300/100 liability with a $500 deductible for collision and comprehensive, is crucial. It means you're not just asking, how much is car insurance? You're asking, how much is it for the exact protection my family needs? It transforms you from a passive price taker into an active, informed shopper. So there you have it. Your driver details, the vehicle VINs, your honest driving history, your proof of continuous insurance, your vehicle usage, your garaging address, and your desired coverages. This is your complete dossier. With this arsenal of information prepared, you are no longer just winging it. You are a prepared, organized, low-risk applicant, ready to get the most accurate and competitive quotes possible in a fraction of the time. You've gathered the intel. You've built your perfect profile. Now you're ready to step onto the battlefield and actually start filling out the forms. But this is where 90% of people make a critical error on the very first page. The initial questions aren't just for information. They are carefully crafted psychological funnels designed to categorize you before you even see a price. And how you answer them can change everything. In the next part, I'm going to show you the number 1 trap people fall into, and reveal the simple 3-word phrase you can use that often unlocks a completely different tier of hidden discounts you would never be offered otherwise. The number 1 trap is something insurers call the loyalty tax. It's a quiet, creeping premium increase that happens over years, and it's designed to be so gradual you barely notice it. They bank on the fact that you're busy, that you'll just see the bill, sigh, and pay it because shopping for new insurance feels like a colossal waste of a Saturday. They are profiting from your inertia. Think about it. When was the last time your current insurance company called you out of the blue and said, "Hey, great news! We found a way to charge you less money this year"? Never happens. The number on the bill only ever goes in one direction. They reward new customers with incredibly low introductory rates to get them in the door, while slowly year after year, they raise the rates on their existing loyal customers who they assume won't leave. It's a penalty for staying put. This is the trap. You think you're being a good, stable customer, but in their system, you're just a predictable revenue stream they can squeeze a little more out of every 6 months. You could be the safest driver in the world, with a perfect record, and your rates will still go up because of rising costs or new risk assessments in your area. These are often just excuses to pad the bill. So, how do you break the cycle? How do you signal to them that you're not just going to roll over and accept the increase? You use a simple 3-word phrase. Before you even think about getting quotes from other companies, you call your current provider. You get an agent on the line, and after the pleasantries, you say these 3 words. Quote me new. Not, can you lower my rate? Not, why did my bill go up? Those questions lead you down their pre-planned script of excuses. But when you say, quote me new, you are speaking their language. You are telling them in code to wipe the slate clean. You are asking them to treat you like a brand new customer walking in off the street. This single phrase forces them to bypass the loyalty tax algorithm. It compels them to run your information through their acquisition system, the one designed to attract new business with the best possible rates, not the retention system designed to see how much you're willing to tolerate. The agent on the other end of the line will know exactly what you mean. Their screen has 2 pathways. One for existing customers, with its built-in incremental increases, and one for new applicants. You are forcing them onto the new applicant path. Suddenly, all those introductory offers, those new customer discounts that you haven't been eligible for in years, are back on the table. It's the single most powerful thing you can say to your current insurer, because it instantly reframes the entire conversation. You're no longer a captive customer complaining about a price hike. You are a potential free agent, one click away from leaving, and they are now in a position where they have to win your business all over again. Now this is where the magic really happens. Saying quote me new is the key that unlocks the door. But once that door is open, you have to know what to ask for. You've shattered their script, and now it's time to run yours. This is where you start systematically checking for every single discount you might be eligible for. Don't assume they'll apply them automatically. You have to ask. Specifically, one by one. First, the easy ones. Are you married? Make sure you're getting a married discount. Do you own a home? That's a discount. Are you bundling your auto with home or renter's insurance? That's a huge discount, often one of the biggest. But let's go deeper. Ask about your occupation. Many people don't realize that certain professions are considered lower risk by insurers. Are you a teacher, a first responder, an engineer, a scientist, a nurse? There are often specific, unadvertised discounts for these careers. You have to ask, do you offer an occupational discount for your job title? Next, ask about affinity groups. Are you a member of an alumni association, a credit union, a professional organization like the American Bar Association or the National Education Association? Are you a member of AAA, AARP, or even a wholesale club like Costco? Many of these groups have negotiated special rates with insurance carriers. Say, I'm a member of organization name. Is there an affinity discount available for that? Then let's talk about your driving habits. Since the pandemic, millions of Americans are driving significantly less. If you're working from home or have a short commute, you need to ask for a low mileage discount. Be specific. Tell them, I drive less than 7,500 miles a year. What kind of discount can you apply for that? Don't let them just brush it off. Insurers track this data obsessively. They know that the less you're on the road, the less likely you are to have an accident. You deserve to pay less. What about your education? If you have a bachelor's degree or higher, some companies offer a discount. And if you have a student in your household, don't just settle for the standard good student discount for having a B average. Ask if they offer a student away at school discount. If your kid is at college more than 100 miles away and didn't take a car with them, your rate should be significantly lower, but it often isn't applied unless you specifically request it. And finally, safety and technology. Your car is probably loaded with safety features that didn't even exist a decade ago. You need to go down the list. Does my policy include a discount for anti-lock brakes? For daytime running lights? For my anti-theft system? For my airbags? Every single yes is more money back in your pocket. Then there's the big one, telematics. This is the program where you use a smartphone app or a small device that plugs into your car to track your driving habits. Things like hard braking, rapid acceleration, and late-night driving. Now, this isn't for everyone. If you have a lead foot or often drive home late from a night shift, it might not be for you. But if you are a genuinely safe, cautious driver, enrolling in a program like Progressive Snapshot or State Farm's Drive Safe, and Safe can lead to discounts of up to 30%. Ask them, what is the maximum discount I can earn with your telematics program, and can I try it without penalty? By going through this checklist, you are reverse engineering their pricing model. You started by breaking out of the loyal customer trap with the phrase, quote me new. Then, you systematically built your own policy from the ground up, bolting on every single discount you're entitled to. The new quote you get at the end of this process will almost certainly be dramatically lower than the renewal notice they sent you. You've just forced your own insurance company to compete for your business and stop taking you for granted. This single phone call can save you hundreds, sometimes even over $1,000 a year. But here's the critical part. This is only step one. This new lower number from your current company, this isn't your final price. This is your starting point. This is the baseline, the number that everyone else now has to beat. Because even with all these discounts, there's a very good chance that another company out there is still hungrier for your business and willing to go even lower. You've successfully negotiated with your current provider. But the real game is about to begin. Now you have to take this new, optimized quote and use it as leverage against their biggest competitors. But there's a science to it. You don't just start calling randomly. The type of company you call first, second, and third can dramatically alter the final quotes you receive. In the next part, I'm going to lay out the quote ladder strategy, the precise order in which you should shop for insurance to create a bidding war and force companies to undercut each other, leaving you with the absolute lowest possible rate. Alright, let's build this quote ladder rung by rung. This isn't just a random list of places to call. The order is critical. It's designed to build leverage at each step, so by the end, you're not just asking for a price, you're dictating the terms of the negotiation. Think of it like a poker game where you get to see more and more of the other player's cards before you make your final bet. The first rung, the foundation of our entire strategy, is your local independent insurance agent. Now, I know what some of you are thinking. An agent? Isn't that old-fashioned? Isn't it faster to just go online? Patience. This is a strategic play, not a speed run. An independent agent is your secret weapon. Your scout sent out into enemy territory. Unlike a captive agent who only works for one company like State Farm or Allstate, an independent agent represents multiple insurance carriers. Dozens sometimes. Here's why this is your first move. You are outsourcing the initial, most time-consuming part of the process. Instead of you filling out 10 different forms for 10 different companies, you fill out one set of information with the agent, and they do the heavy lifting. They will shop your profile to their entire network of carriers, companies like Travelers, Safeco, Nationwide, and many smaller regional players you've probably never even heard of. These smaller companies can often have incredibly competitive rates for specific types of drivers, but they don't have the billion-dollar advertising budgets to reach you directly. Your independent agent is the only bridge to them. By starting here, you accomplish two crucial things. First, you get a broad survey of a huge chunk of the market with minimal effort. Second, and most importantly, you establish a powerful baseline quote. The agent will come back to you with the best 1, 2, or 3 options from their network. Let's say the best they find is a policy for $150 a month. Perfect. That number 150 is now your weapon. It's the benchmark that every other company will have to beat. You've established the high water mark, and from here on out, we're only going lower. You thank the agent, tell them you're reviewing the options, and you do not commit to anything yet. We're just gathering intelligence. Now we climb to the second rung of the ladder. The captive agents. These are the agents who work exclusively for one of the big household names, your Allstate, your State Farm, your Farmers Insurance. These are the folks with the nice offices on Main Street. Why are they our second stop? Because they are the direct competitors to the companies your independent agent just shopped. And now you're not walking in empty-handed. You don't call them and ask, "How much is your car insurance?" That's a rookie mistake that puts them in control. Instead, you call them or walk in with a completely different energy. You say, "Hi, I'm currently with your current insurer, and I'm shopping my rates. I've already received a quote from another carrier for the exact same coverages, and it's $150 a month. I've always heard good things about your company, and I wanted to give you a chance to earn my business. Can you beat that price?" Do you see the massive psychological shift? You've just flipped the entire script. You're not a customer asking for a price. You're a savvy shopper presenting a challenge. You've anchored the negotiation. Their brain is no longer thinking, "What's the most we can charge this person?" It's thinking, "Okay, the target is $150. What discounts can I find? What can I tweak to get under that number and steal this customer?" You have forced them to sharpen their pencil and look for every possible discount. They know you're a serious shopper, not a tire kicker, because you've already done your homework. You repeat this process with 2 or 3 of the major captive agents in your area. Maybe one of them comes back at $145. Excellent. That is your new benchmark. The old number is dead. $145 is the price to beat. With our new lower benchmark in hand, we climb to the third rung, the online aggregators. This is the digital battlefield. I'm talking about sites like the Zebra, Gabi, or Insurify. Now, you have to understand what these sites are. They are not insurance companies. They are sophisticated lead generation platforms. You put your information in once, and they blast it out to their network of partners who then provide you with quotes. A lot of people make the mistake of starting here. That's a tactical error. When you start with an aggregator, you're a complete unknown. You get a flood of quotes, a storm of emails and phone calls, and you have no idea what's a good deal and what isn't. It's overwhelming and inefficient. But when you come to them on the third rung of our ladder, you are in command. You know the price to beat is $145 a month. You can now use these powerful search engines with surgical precision. As you look at the list of quotes they generate, you can immediately discard everything that's over $145. You're not wasting time analyzing a $160 quote. You are laser-focused on the 2 or 3 that came in lower. Maybe a company you've never heard of like Esurance or a smaller online-only player comes in at $135. Fantastic! We have a new champion. A quick pro tip. When you use these sites, consider using a secondary email address and a Google Voice phone number. This way, you can contain the flurry of marketing that follows without blowing up your personal inbox and phone. Once you've found your policy, you can just shut that number and email down. You've used the tool for its power, and you've sidestepped the annoyance. Now for the top of the ladder, the final rung, the boss level. This is where we go head-to-head with the two titans of the industry that often don't play well with others, Geico and Progressive. These two companies spend billions, with a B, on advertising for one reason. They want you to come to them directly. They have built their entire business model on cutting out the middleman, whether that's an independent agent or even some of the aggregator sites. Because they operate at such a massive scale and have lower overhead costs from not paying agent commissions, they can sometimes offer rates that are simply untouchable by anyone else. But not always. That's why they are our final stop. This is the ultimate test. You take your absolute best quote, that $135 a month policy we found on the aggregator, and you go directly to the Geico and Progressive websites. One at a time, you meticulously plug in your information, making sure every single coverage limit, every deductible, every detail is an exact, apples-to-apples match with the quote you're trying to beat. This is the moment of truth. You've leveraged the work of an independent agent to survey the field. You've used that intel to force the captive agents to compete. You've used that new low price to filter the noise of the online aggregators. And now you're taking your champion quote and putting it up against the biggest players in the game. You hit that See My Rate button and you see what happens. Can the Gecko beat 135? Can Flow? Sometimes they can, and you'll save another $10 or $15 a month. Sometimes they can't, and that confirms that the 135 quote you found earlier is truly the rock bottom price for your specific profile. Either way, you win. You have absolute certainty that you have squeezed every last drop of savings out of the market. You didn't just get a quote, you manufactured the lowest possible price through a systematic multi-step process that put all the leverage, all the power squarely in your hands. So let's put that power to work. The very first step in our comparison assault is to establish a benchmark, a baseline. We need to draw a line in the sand that every other company will be forced to either meet or beat. We're going to call this your control quote. This isn't just a random price you get from the first company you see on a commercial. This is a strategically chosen starting point that will anchor your entire negotiation process. Think of it like the manufacturer's suggested retail price. It's the initial number that we are going to systematically dismantle piece by piece. Where you get this control quote matters. You have three primary options. First, you can go to a captive agent, someone who only sells for one company like State Farm or Allstate. Second, you can go to an independent agent or broker who represents multiple companies. Or third, you can go directly to a company online like a Geico or a Progressive. For the purpose of establishing our control quote, I recommend you start with one of the big, direct-to-consumer national players. Why? Because their pricing is often highly automated and serves as a fantastic, middle-of-the-road benchmark for the entire industry. They spend billions on advertising to be the default choice, so let's use their default price as our default target. Go to their website, fill out their form with the exact pristine information we gathered in the previous step, and get that first number. Now stop. Do not move on. Do not immediately start looking for another quote. The biggest mistake people make is collecting a pile of prices without understanding what's inside those prices. That number on the screen is meaningless without context. This is where we go from amateur shopper to professional negotiator. We are going to dissect this control quote with the precision of a surgeon. Pull up the full quote details. It's usually a PDF or a detailed web page. You're looking for three critical sections: coverages, limits, and deductibles. This is the DNA of your policy, and you need to understand it cold. First, let's talk coverages. This is the secret language insurers use, but it's actually simple. You'll see several lines. Bodily injury liability. That's the big one. If you cause an accident and someone gets hurt, this pays for their medical bills, their lost wages, their pain and suffering. This is what protects your entire financial life from being wiped out by a lawsuit. Next is property damage liability. This pays to fix or replace the other person's car, or their fence, or their storefront, or whatever else you hit. These two together are your liability coverage, the part that's legally required in almost every state. Then you'll see things like uninsured or underinsured motorist. This is crucial. It protects you if you're hit by someone who has no insurance or not enough insurance to cover your medical bills. It's insurance on the irresponsible. Don't skip it. You might also see medical payments or personal injury protection, often called MedPay or PIP. This helps pay for your own or your passenger's medical expenses after an accident, regardless of who is at fault. It's fast, direct coverage for immediate needs. Finally, you get to the two that cover your actual car: collision and comprehensive. Collision is exactly what it sounds like. It pays to repair your car if you hit another car, a tree, a pole, whatever. It's about impact. Comprehensive is for almost everything else. Theft, vandalism, a rock cracking your windshield, a tree branch falling on your roof, hitting a deer. Think of it as the acts of God and chaos coverage. Now that you know what these words mean, look at the second critical section. The limits. Next to your liability coverages, you'll see numbers that look like a secret code, something like 50/100/25. This isn't random. It's the most important part of your quote. That first number, 50, means your insurer will pay up to $50,000 for any single person's bodily injuries in an accident you cause. The second number, 100, is the maximum they'll pay for all bodily injuries combined in that single accident. The third number, 25, is the maximum they'll pay for all property damage you cause. Let me be brutally clear. Simply getting your state's minimum required limit is one of the most dangerous financial gambles you can take. State minimums are terrifyingly low. In some states, the property damage minimum is just $5,000 or $10,000. What happens when you slide on some ice and your 10-year-old sedan taps the bumper of a brand new Tesla or a BMW? That's a $20,000 repair easy. If you only have $10,000 in coverage, guess who's getting a bill? And a potential lawsuit for the other $10,000? You are. All your savings, your wages, everything is on the line. Choosing your limits isn't about saving a few bucks a month. It's about building a firewall around your life. The third section to analyze is your deductibles. You'll only see these next to your collision and comprehensive coverages. A deductible is simply the amount of money you have to pay out of your own pocket for a repair before the insurance company pays a single penny. So, if you have a $1,000 deductible and you get into an accident that causes $5,000 of damage to your car, you pay the first $1,000, and the insurance company pays the remaining $4,000. It's a simple relationship. The higher your deductible, the lower your monthly premium will be, because you're agreeing to take on more of the financial risk yourself. The key is to choose a deductible you could comfortably write a check for tomorrow without causing a financial crisis. Don't pick a $2,000 deductible to save $15 a month if you don't have $2,000 in an emergency fund. Okay, deep breath. You've now decoded your control quote. You understand the language. Now we turn this knowledge into a weapon. Open up a spreadsheet. Google Sheets, Excel, a piece of paper, and a ruler, I don't care. Create the following columns. Carrier name, 6-month premium, bodily injury limit, property damage limit, uninsured motorist limit, collision deductible, comprehensive deductible, and a final crucial column, notes. In the first row, you're going to enter the details of your control quote. Put the company's name. Enter the 6-month premium, not the monthly one, because it's the most accurate for comparison. Then meticulously fill in each limit and each deductible. In that notes column, I want you to list any extras they included. Did they throw in roadside assistance? Rental car reimbursement? Accident forgiveness? Write it all down. This spreadsheet is now your battlefield map. It is the single source of truth. From this moment forward, you are no longer comparing vague, confusing prices. You are now conducting an apples-to-apples military-grade analysis. Every other quote you get will be held up against this first row. It must have the exact same coverages, the exact same limits, and the exact same deductibles. If a new quote comes in with a 100/300/100 liability limit, it's not a valid comparison to your 50/100/25 control quote. You have to make them match. This is the only way to know if you're actually getting a better deal, or if they're just quietly selling you a weaker, inferior policy for less money. What you've just done is build the framework for victory. You have your benchmark. You have your standardized comparison tool. You've transformed a chaotic mess of industry jargon into a clean, clear set of data points that you control. This control quote is no longer just a price. It's a challenge. It's the gauntlet you're about to throw down in front of every other insurance company in the country. And in the next step, we're going to take this challenge and use it to start a bidding war for your business. Welcome to the arena. This is where the game is truly played. That first quote you got isn't just a piece of paper or an email with a number on it. It's your opening bid. It's the baseline, the standard, the price to beat. You are now the most sought-after free agent in the insurance market, and every company is a team trying to sign you. Your job is to orchestrate a competition so fierce that they start driving their own prices down just to win you over. So how do we do this? We take our benchmark quote and we march it into 3 distinct battlefields. Each one has its own rules, its own advantages, and its own weaknesses. Understanding them is the key to your victory. The first battlefield is the direct-to-consumer channel. These are the giants you see on TV every 5 minutes. Think Geico Progressive Insurance. You go directly to their website or call their 800 number. The advantage here is speed and control. You're cutting out the middleman. You can get a quote in 10 minutes at 2 in the morning while eating cereal in your pajamas. You're in the driver's seat, inputting the information yourself. The potential downside? You're only seeing one team's offer. Geico is only going to sell you Geico. They're not going to tell you that their biggest rival could save you $300. It's a one-on-one negotiation, and it can be incredibly time-consuming to do this with 5, 6, or 7 different companies. You're essentially applying for a new job over and over again. The second battlefield is the realm of the captive agent. This is your local State Farm agent, your Allstate representative, the person with an office on Main Street. The word captive is key here. They are an agent who works for and can only sell products from one single insurance company. The massive advantage of a captive agent is the personal relationship. They get to know you, your family, your specific needs. They can be an invaluable advisor, especially when it comes to bundling your car insurance with your home or renter's policy. They can be your advocate during a claim, but their limitation is baked into their name. They are captive. Your State Farm agent is a fantastic expert on State Farm, but they cannot, by law, sell you a policy from Nationwide, even if it's a better fit or $100 cheaper. They're playing for one team and one team only. Now for the third battlefield. This is the one most people don't know about or don't fully understand. And frankly, it can be your secret weapon. This is the world of the independent agent or broker. Unlike a captive agent who works for the insurance company, an independent agent works for you. They are not beholden to any single brand. Instead, they have contracts and appointments with dozens of different insurance carriers, companies you've heard of, and many excellent regional ones you haven't. Think of it this way: going direct is like going to the Nike store. You can only buy Nike. Going to a captive agent is like having a personal shopper who only works for Nike. They know everything about Nike, but they're still only going to sell you Nike. An independent agent is like a personal shopper who can take you to Nike, Adidas, New Balance, Puma, and 10 other stores to find the absolute best shoe for you at the best price. You go to one independent agent, give them your information one time, and they do the shopping for you across multiple companies. They bring the quotes back to you laid out on a silver platter. They can see the entire market in a way you simply can't. This is maximum firepower with minimum effort. You're leveraging their expertise and their technology to create the bidding war for you. So, your strategy is to engage on all 3 fronts. Get at least 2 quotes directly from the big online players. If you value a personal relationship, talk to a captive agent from a major brand. And absolutely, find a highly rated local independent agent and have them run the numbers for you. Now, when you approach them, you need a game plan. You need a script. You don't just walk in and say, "How much for car insurance?" You walk in with the gauntlet we talked about, your benchmark quote. The conversation should sound something like this: "Hi, I'm currently with your current insurer, and I have a renewal offer, or a competitive quote, for a 6-month policy at your benchmark price. I'm looking to make sure I'm getting the best value. Can you see if you can beat that price for the exact same coverage?" And that phrase, "the exact same coverage," is the most important part of this entire process. This is the cardinal rule of comparing car insurance. It must be an apples-to-apples comparison. If you fail at this, everything else is a waste of time. A quote that's $50 cheaper is not a win if it secretly slashed your liability limits in half or doubled your deductible. That's not a better deal. That's a more dangerous one. You need your current policy's declarations page in front of you. It's your cheat sheet. Every single number on every new quote must match it perfectly. Let's be specific. Your bodily injury liability limits. If your benchmark is 100/300/100, which means $100,000 per person, $300,000 per accident, and $100,000 in property damage, then every single quote you get must say 100/300/100. Don't let anyone quote you at the state minimum just to show you a lower price. That's a classic bait and switch. Your uninsured and underinsured motorist coverage. Match it. If you have $100,000 on your current policy, you need $100,000 on the new quote. Your medical payments or personal injury protection. Match the limit exactly. And the big ones, collision and comprehensive. The deductibles must be the same. A deductible is the amount you pay out of pocket before the insurance company pays a dime. Switching from a $500 deductible to a $1,000 deductible will absolutely lower your premium, but it also means you're on the hook for an extra $500 if you get into an accident. Are you saving enough on the premium to justify that extra risk? Maybe, but you have to make that decision consciously. Don't let an agent or a website make it for you by sneaking in a higher deductible to make their price look better. You need to be a hawk. Go line by line. Liability, collision, comprehensive, rental reimbursement, roadside assistance, every single coverage, every single limit, every single deductible, identical. Only then, when you have two or more quotes that are perfect mirror images of each other in terms of coverage, can you truly compare the price. Once you've gathered your intelligence from these three battlefields, you'll have a stack of quotes. One of them will be the new leader. Let's say you started with a benchmark quote of $800 for 6 months. After shopping around, an independent agent found you the exact same coverage with a different A-rated carrier for $650. This is where the real power play begins. The bidding war isn't over. This is just round one. Now you take that winning $650 quote and you go back. You can go back to your current insurance company, the one you've been with for 10 years. You call your agent and you're honest. Listen, I love being with you guys, but I have a competing offer here for the identical coverage at $650. Is there anything you can do to match that or get closer? I'd prefer to stay, but it's a significant difference. You've just turned the tables. You're no longer a price taker. You're a price maker. You're giving them a chance to keep your business. Sometimes they'll have a little wiggle room. They might find a new discount you qualify for, or re-rate your policy and magically find a way to lower the price. Other times they'll say no, but you lose absolutely nothing by asking. You can do the same with the second place company. You quoted me at $700, but I have a firm offer at $650. If you can match it, the business is yours. This is how you ensure you're not leaving a single dollar on the table. You use competition to create leverage, and you use that leverage to get the absolute best deal possible. But remember, the lowest number isn't the end of the story. A low price from a terrible company is a trap. It's a promise that won't be kept when you need it most. So once you've found the best price, you have to answer a final crucial question. Is the company behind that price any good? And evaluating the company, not just the quote, is where we're going next. Think of it like this. You're hiring someone for the most important job in your financial life. Their one and only task is to show up with a giant bag of money and make you whole again on what might be the worst day of your year. You've received bids from several candidates. One of them is way cheaper than the others. Do you instantly hire the cheapest one? Or do you check their references first? Of course you check their references, because a low price is worthless if the person flakes on you when the crisis hits. Your insurance company is that person, and their references are their financial strength, their customer service record, and their complaint history. These three pillars tell you everything you need to know about whether that low price is a bargain or a trap. Let's start with the most important pillar, the one that holds everything else up: financial stability. This answers a very simple but terrifyingly important question. If a massive disaster strikes, a major hurricane, a widespread wildfire, a catastrophic ice storm that causes thousands of accidents, will your insurance company have enough cash on hand to pay all its claims, including yours? Or will it go bankrupt, leaving you with nothing but a worthless piece of paper? This isn't just a theoretical problem. It happens. After major disasters, smaller, less stable insurance companies can and do fail. That's why you need to check their financial strength rating. The undisputed gold standard for this is a company called AM Best. They've been rating the financial health of insurance companies for over a century. They do a deep forensic dive into a company's balance sheets, their investments, and how much cash they keep in reserve. AM Best then assigns a letter grade just like in school. These grades range from A++ for superior, all the way down to D for poor. So what should you look for? Honestly, you shouldn't even consider a company that isn't rated a dash or higher. An A- rating from AM Best means the company has an excellent ability to meet its ongoing insurance obligations. Anything in the A range-ish, A+, is a solid bet. Companies in the B range are considered good or fair, but you're introducing a level of risk that just isn't necessary when there are so many A-rated companies to choose from. Think of it as a minimum requirement. If a company can't get at least an A from AM Best, they are disqualified. End of story. You can usually find a company's AM Best rating right on their website, often in the About Us or Investor Relations section. If you can't find it, that's a red flag in itself. You can also go directly to the AM Best website to look it up. Don't skip this step. It takes 30 seconds, and it protects you from the catastrophic risk of your insurer going under when you need them most. It's the foundation. If the foundation is cracked, it doesn't matter how nice the rest of the house looks. Okay, so you've confirmed the company can pay. The foundation is solid. The next question is, how will they pay? Will they be helpful, efficient, and fair? Or will they drag you through a bureaucratic nightmare of endless phone calls, lost paperwork, and lowball settlement offers? This is where we evaluate the second pillar: customer service and claims satisfaction. While financial ratings are about numbers on a spreadsheet, customer satisfaction is about human experience. The best source for this kind of data is J.D. Power. They conduct massive independent surveys of real customers, asking them about their experience with everything from the initial purchase process to billing, but most importantly, the claims process. The claims process is the moment of truth. It's the one time you actually use the product you've been paying for. A company can have a slick website and friendly sales agents, but if their claims department is a disaster, none of that matters. That's why when you look at J.D. Power ratings, you need to dig past the overall satisfaction score and look specifically for the claims satisfaction study. J.D. Power ranks companies on a 1,000-point scale and typically groups them into tiers like better than most, about average, and the rest. Your goal is to stick with companies in that top better than most tier. These are the insurers who consistently get high marks from their own customers for how they handle the most stressful part of the insurance experience. They are praised for clear communication, fair appraisals, and timely payments. The companies at the bottom of these rankings are there for a reason. Their customers have reported frustrating experiences, unreturned phone calls, adjusters who tried to nickel and dime them on repairs, and a process that feels designed to make them give up. The difference in price between a top-ranked company and a bottom-ranked one might be a few $100s a year. But the difference in your stress level and financial outcome after an accident can be immeasurable. Paying a little extra for a company that is known to handle claims well isn't a cost. It's an investment in your own peace of mind. So now you've got a company that's financially stable and has a great reputation for customer service. You're almost there, but we have one more reference to check. This is the one most people don't even know exists, and it might be the most revealing of all. We need to check their official complaint record. This is our third pillar. Every state has a Department of Insurance, which is a government body that regulates insurance companies and serves as a watchdog for consumers. When a customer has a serious problem with an insurer that they can't resolve directly, like an unfairly denied claim or a settlement that's way too low, they can file a formal complaint with their state's Department of Insurance. This is a big deal. People don't file these formal complaints over minor inconveniences. They file them when they feel they've been seriously wronged. And all of this data is collected and centralized by a national organization called the National Association of Insurance Commissioners, or the NAIC. The NAIC takes all the verified complaints filed against an insurance company from across the country and compiles them into a single powerful metric: the company's complaint ratio, or complaint index. This isn't just a raw number of complaints, because that wouldn't be fair. A giant company with millions of customers will naturally have more complaints than a small regional one. Instead, the NAIC creates a ratio that compares a company's share of complaints to its share of the market. The national average is always set at 1.0. So, a company with a complaint index of 1.0 has a perfectly average number of complaints for its size. A company with an index of 0.5 has half as many complaints as you'd expect for its size, which is excellent. But a company with an index of 2.0 has twice as many complaints as its peers. That is a massive red flag. It's a statistical siren telling you that customers of this company are significantly more likely to have a problem so bad they had to get the government involved. You can find this information by going to the NAIC website or sometimes by searching for your state's Department of Insurance Complaint Ratio report. Look up the company you're considering. Is their complaint index below 1.0? Great. Is it well above 1.0? You need to seriously ask yourself why. Maybe that low price they quoted you is possible because they cut corners, deny claims more often, and make life difficult for their customers. The complaint index cuts through all the marketing fluff and gives you the hard, cold data on how often a company generates serious problems for its policyholders. Putting it all together, you now have a 3-point inspection process for any insurance quote. First, check AM Best for financial stability. Is it A or better? Second, check JD Power for claim satisfaction. Is it in the top tier? And third, check the NAIC Complaint Index. Is it at or below the national average of 1.0? If a company passes all three of these checks, you can be confident that the price they've quoted you is attached to a solid, reliable promise. You've found a company that is not only affordable, but is also financially sound, treats its customers well, and doesn't generate an unusual number of serious complaints. You've done your due diligence. You've checked the references. Now and only now can you truly compare the quotes you've gathered on an apples-to-apples basis and make a final decision. But before you pull the trigger, there's one last crucial phase. A final review of everything you've chosen to make sure there are no hidden surprises. This is your last line of defense against a policy that looks good on the surface but is full of holes underneath. It's the final pre-flight check before you commit. So, grab the quote that's currently in first place and let's put it under the microscope. The single most important document you need to scrutinize right now is called the declarations page. Think of it as the cover sheet, the summary, the cheat sheet for your entire insurance contract. If something isn't right on this page, it's not right, period. First, the basics. And I mean the absolute basics. Check your name. Is it spelled correctly? Check your address. Is it the right one down to the zip code? This might sound ridiculously simple, but a single typo can create a cascade of problems, from billing issues to claim denials. Insurers use your address to rate your policy. A wrong address means you're being rated on incorrect information, which could void your coverage if they discover it during a claim. Next, look at the vehicles. Every car you want insured should be listed, identified by its full vehicle identification number, or VIN. Pull out your car's registration and compare the VIN on the quote, character for character. A single digit off and you might technically be insuring a completely different car. Make sure the year, make, and model are also 100% accurate. Now check the drivers. Is every licensed driver in your household who will be using the cars listed on the policy? Or if you chose to exclude someone, is that exclusion clearly noted? Don't assume anything. If your teenager just got their license and you forgot to add them, that's a massive gap in coverage waiting to happen. With the basics confirmed, we move to the heart of the policy, the coverages. This is where you need to be meticulous. Go line by line and compare the numbers on the declarations page to the numbers you wrote down in your notebook or spreadsheet. Bodily injury liability. Does it say 100/300/100 just like you requested? Or did they default to the state minimum of 25/50/25? Property damage liability. Is it the $100,000 you wanted? Look at your uninsured and underinsured motorist coverage. Do the limits match your liability limits as we discussed? Then look at the physical damage coverages for your own car. Collision. Does it list a $500 deductible? Or did it somehow get switched to $1,000? Comprehensive. Is the deductible what you decided on? This is a common area for discrepancies. An agent might have tweaked a deductible to hit a certain price point, and if you don't catch it now, you won't find out until you're filing a claim and suddenly have to pay twice as much out of pocket as you expected. Next up, the add-ons, those endorsements and riders we talked about. Did you ask for rental reimbursement? If so, you should see a line item for it, specifying the coverage like $40 per day, up to a maximum of $1,200. Did you want roadside assistance? It should be listed. If you opted for new car replacement or gap insurance, it needs to be explicitly stated on that declarations page. If it's not written there, you do not have it. A verbal promise from an agent is not a contract. The declarations page is the contract. And finally, on that page, look for the list of discounts. This is your reward for being a savvy shopper. Is the multi-policy discount for bundling with your home or renter's insurance applied? Is your good driver discount there? What about the discount for paying in full or for going paperless? Each one of these might only be a few dollars a month, but they add up. If a discount you know you qualify for is missing, you need to ask why before you pay a single cent. Once you've given the declarations page a thorough review and everything lines up, it's time for the final broader evaluation. The price is great, the coverages are right, but is this a company you actually want to do business with? Because when you have a claim, you're not dealing with a price tag. You're dealing with a person, a claims adjuster, a customer service department. This is your last chance to consider the company's reputation. Think back to the research you did. What did the JD Power rating say about their claim satisfaction? What was their complaint index with the National Association of Insurance Commissioners, the NAIC? A low price from a company with a terrible claims handling reputation is a terrible value. You're paying for a service you hope you never need, but if you do, you need it to work. Saving $150 a year is meaningless if the company fights you tooth and nail over a legitimate $20,000 claim. Also, consider the user experience. In this day and age, how easy is it to interact with the company? Download their mobile app. Can you log in easily? Can you view your ID cards, pay a bill, or start a claim? Imagine it's 10 p.m. on a Friday, and you've been in a minor fender bender. You don't want to be fumbling with a clunky, outdated app, or trying to navigate a website that barely works on your phone. A smooth, modern digital experience is part of the product you're buying. Finally, look at the payment terms and any associated fees. Does the quote assume you're paying for the full 6 or 12 months up front? If you choose to pay monthly, do they add a hefty installment fee? Some companies charge anywhere from $3 to $10 per payment for the privilege of paying monthly. That can add over $100 to the annual cost, potentially making a seemingly cheaper quote more expensive than the runner-up. Are there fees for paying with a credit card versus a bank account transfer? These are the little details that can leave a sour taste if they catch you by surprise. Okay, you've done it. You've reviewed the documents, you've rechecked the company's reputation, and you've confirmed the payment details. You're confident in your choice. It's time to make it official. It's time to purchase the policy. Have your information ready, your driver's license number, and the VIN for your vehicle. You'll also need your payment information, whether it's a credit card or your bank's routing and account number. You can typically complete the purchase online or over the phone with an agent. As you go through the final steps, pay close attention to one critical detail: the effective date and time of the new policy. This is the exact moment your new coverage begins. It could be immediate, like 3:45 p.m. on today's date, or you could set it to start in the future, like at 12:01 a.m. on the day your old policy expires. Once you submit your payment, you should receive immediate confirmation, usually in the form of a confirmation number on the screen and a follow-up email. This email is your first piece of proof that you have a new active policy. It will often include temporary insurance ID cards you can print out. Your new declarations page and the full policy booklet will typically follow in the mail or be available to download from your online account. Now, I need you to listen very carefully, because this next step is the single most important part of the entire transition process, and it's where people make a catastrophic mistake. Do not, I repeat, do not cancel your old insurance policy yet. Not until you have written, legally binding confirmation that your new policy is active and in force. Never, ever create a situation where you might have a lapse in coverage, not even for a minute. A lapse in coverage is a massive red flag to insurance companies and can cause your rates to skyrocket in the future. It can also get you in serious trouble with your state's DMV and if you have a car loan with your lender. The golden rule is this: secure the new, then release the old. It's like swinging on a trapeze. You don't let go of the bar in your hands until you have a firm grip on the next one. Wait until you have your new policy documents in hand, or at least the official email confirmation and ID cards. Only then is it safe to contact your old provider to cancel. You've navigated the quotes, you've dissected the coverages, and you've made an informed, confident decision. The hard part is over. You've locked in the best possible protection for the best possible price. But your work isn't quite finished. Now you have to manage the transition perfectly, tying up all the loose ends to ensure a seamless switch from your old insurer to your new one. This is the moment where a simple mistake can cost you thousands of dollars, erase all the savings you just fought for, and even get you in trouble with the law. The single most important rule of switching car insurance is this: you must never, ever have a gap in your coverage. Not for a day, not for an hour, not even for a minute. A lapse in coverage is a red flag to the entire insurance industry. It tells them you're a higher risk. The moment you have a lapse, your rates for the future will skyrocket, wiping out any benefit you got from switching. Worse, if you happen to get into an accident during that uninsured window, even if it's just backing out of your own driveway, you are personally on the hook for every single dollar of damage. We're talking medical bills, property damage, lawsuits. It's a financial catastrophe. And let's not forget, driving without insurance is illegal in nearly every state. Getting pulled over during a lapse could mean hefty fines, a suspended license, and even your vehicle being impounded. So, how do we execute this transition with surgical precision to avoid that nightmare scenario? We follow a clear, methodical plan. First, before you do anything else, get your new policy in writing. Don't just rely on a verbal confirmation over the phone. Ask the agent for the official policy declarations page, to be emailed to you immediately. This is your contract. It's the proof. When you get that document, don't just skim it. Go through it with a fine-tooth comb. Verify every single detail. Are the vehicle identification numbers, the VINs, for all your cars correct? Is your name and address spelled perfectly? Most importantly, do the coverages and deductibles listed on that page match exactly what you were quoted? Check the liability limits, the comprehensive and collision deductibles, and any add-ons like rental reimbursement or roadside assistance. If there is even one tiny discrepancy, you need to call them back immediately and get it corrected before you pay a single cent. This is your last chance to ensure you're getting the policy you agreed to. Once you've confirmed everything is perfect, you're ready for the next step. Now it's time to make it official. You need to activate your new policy, and that means making the first payment. A quote is just a promise. Payment is what turns that promise into a legally binding contract of protection. You can usually do this online through their portal or over the phone with an agent. My recommendation is to do it in a way that gives you instant confirmation. Once the payment is processed, you should immediately receive a policy number and access to your temporary insurance ID cards. Don't hang up the phone or close the browser window until you have that policy number in your hand. Download and print your new ID cards right then and there. This is your tangible proof that the new policy is active. Pay close attention to the effective date on those cards. This is the exact date and time your new coverage begins. Let's say your new policy becomes effective at 12:01 a.m. on July 15th. This date is now your anchor point for the entire transition. With your new policy officially active and the start date confirmed, it's time to cancel your old policy. And the timing is everything. You will call your old insurance company and tell them you want to cancel your policy effective at 12:01 a.m. on July 15th, the exact same time your new policy begins. This creates a seamless, airtight transition. One policy ends and the new one begins in the very same second. There is zero gap, zero lapse, zero risk. When you call to cancel, the agent may try to win you back. They might suddenly find a new discount or offer to reevaluate your rate. Be polite but firm. You've already done your homework, you've run the numbers, and you've made your decision. Simply state, "Thank you for the offer, but I've already secured a new policy and I need to proceed with the cancellation." The most critical part of this step is getting confirmation. After the phone call, you must get written proof that your policy has been canceled and the date the cancellation is effective. Ask them to email you a cancellation confirmation letter while you are still on the phone. Do not accept a verbal "okay, you're all set." I've heard horror stories of people who thought they canceled, only to find out the company kept billing them, or worse, sent them to collections for non-payment on a policy they believed was terminated. Written confirmation is non-negotiable. It's your defense against any future billing errors or disputes. If they can't email it, ask them to mail it and make a note of the date, time, and the name of the representative you spoke with. Now, what about the money you already paid to your old insurer? If you're like most people and pay your premium in advance, say for a 6-month term, and you cancel 2 months in, you are owed a refund for the remaining 4 months. This is called a prorated refund. During your cancellation call, ask the representative to confirm the amount of your refund and when you can expect to receive it. Typically, it takes a couple of weeks for the check to be mailed or for the direct deposit to hit your account. Keep an eye out for it. If it doesn't arrive in the time frame they gave you, call them back. Also, be aware that some companies charge a small cancellation fee. It's often around 10% of the remaining premium or a flat fee. While it's annoying, it's usually a small price to pay for the hundreds or even thousands you'll be saving over the year with your new lower rate. Okay, the switch is complete. Your old policy is canceled, your new one is active, and you have a refund on the way. But there are a few crucial housekeeping tasks left to ensure you're truly finished. First, take those new insurance ID cards you printed out and immediately place one in the glove compartment of each of your vehicles. Also, save a digital copy to your phone. You need to be able to produce proof of insurance at a moment's notice. Second, and this is a step that millions of people forget, you must notify your lien holder. If you have a loan or a lease on your vehicle, your lender or leasing company needs to know about your new insurance. Your financing agreement requires you to maintain a certain level of coverage, specifically comprehensive and collision, to protect their investment. They need to be listed as a loss payee on your new policy. This just means that if the car is totaled, the insurance check goes to them first to pay off the loan. Call your new insurance company and tell them you need to add your lender as a loss payee. They'll need the lender's name and address. Then you need to send proof of your new insurance to the lender. If you don't do this, the lender will assume you've dropped coverage. They will then take out a policy on your behalf called force-placed insurance, which is outrageously expensive. We're talking 3 to 5 times what you would normally pay. And it only covers their interest in the car, not your liability. They will add this massive cost to your monthly car payment. It is a costly, stressful mistake that is so easily avoided. Make that call. Send that proof. Finally, manage your money. If you had automatic payments set up with your old insurer, go into your bank or credit card account and cancel that authorization immediately. This prevents any zombie payments from being accidentally withdrawn after you've canceled. Then, set up autopay with your new insurer if that's your preferred method of payment. You've successfully navigated the switch, locked in your savings, and you're fully protected. You've handled the logistics like a pro, avoiding every common pitfall from the dreaded coverage lapse to the lender's force-placed insurance trap. But the game isn't over. The best drivers know that getting a great rate is one thing, keeping it is another. And that's where most people drop the ball. Securing this new policy isn't the finish line. It's the starting line for a new, smarter way of managing your insurance costs for the long haul. Because the moment that new policy is active, a countdown timer begins. It's a silent one-year clock that most people ignore, and it's ticking down to your renewal. This is the moment of truth. This is where the savings you just fought for are either locked in for another year, or they vanish into thin air, eaten away by a surprise rate hike you never saw coming. The single biggest mistake drivers make is what I call premium amnesia. They do all this hard work, they find a fantastic deal saving hundreds, maybe even $1,000. They feel that rush of victory, and then they forget. They set up autopay, file the digital ID card away, and don't think about car insurance again for 364 days. The insurance companies love this. They are banking on it. Their entire business model thrives on our inertia. They know that life gets busy, that comparing quotes feels like a chore, and that a small incremental price increase at renewal probably won't be enough to jolt you into action. But what if that small increase isn't so small? What if it's 5%, 7%, 10%? Compounded over a few years, you're right back where you started, overpaying by a huge margin, all because you took your eye off the ball. Your new mission isn't just to get a low rate, it's to defend it. Think of yourself as the CEO of your own household finances, and car insurance is a significant line item on your budget. You wouldn't let a supplier randomly jack up prices on you by 10% without a phone call, would you? Of course not. So why do we let insurance companies do it? The defense starts with a simple, powerful habit: the annual insurance review. I want you to go to your calendar right now, find the date your new policy is set to expire next year, and go back 1 month. Set an appointment with yourself. Title it Shop Car Insurance. Make it non-negotiable. This one 30-minute calendar event is your secret weapon. It's the scheduled, deliberate action that separates the savvy consumer from the one who gets taken for a ride. About 3 to 4 weeks before your policy renews, you'll get a packet in the mail or an email in your inbox. This is your renewal offer. Do not just glance at the price and file it away. This document is a report card on your insurer. Open it, scrutinize it. The first thing you're looking for is the bottom line. The new premium. Is it higher, lower, or the same? If it's higher, you need to become a detective. Why? Sometimes the reason is you. Did you get a speeding ticket this year? Were you in an at-fault accident? These are legitimate reasons for a rate increase. But often the reason has nothing to do with you. Maybe the company filed for a statewide rate hike because of increased repair costs or more accident claims in your region. Maybe inflation is hitting their bottom line. These are factors outside your control, but they don't mean you are powerless. They are simply signals. A signal that the market has shifted, and the company that was the cheapest for you last year may no longer hold that title. This brings us to the loyalty myth. We are conditioned to believe that loyalty is rewarded. With airlines, you get status. With coffee shops, you get a free latte. With car insurance, loyalty can often get you penalized. It sounds crazy, but there's a practice in the industry called price optimization. It's a fancy term for a simple, brutal algorithm. The company analyzes your data and tries to predict how likely you are to shop around. If their data suggests you're a sticky customer, someone who is unlikely to leave, they may incrementally raise your rates year after year, squeezing more profit out of you because they bet you won't go through the hassle of comparing quotes. They are rewarding your loyalty with a secret tax. The only way to fight this is to prove their algorithm wrong. By shopping around, you are sending a clear message. My business is earned, not owned. So your calendar reminder goes off. You've reviewed your renewal offer, and the price has gone up for no good reason. Your action plan is simple. Step 1. Call your current provider. Don't be confrontational. Be curious. Say something like, "Hi, I just received my renewal offer, and I noticed the premium increased by $80. My driving record has been clean, so I was hoping you could help me understand the change." This does two things. First, it puts them on the spot to justify the cost. Second, it opens the door for them to find you savings. Ask them directly, "Is there anything we can do to lower this? Are there any new discounts I might qualify for?" Sometimes they'll find a way to keep your business. They might rerun your quote, apply a new discount, and bring the price back down. But if they can't or won't, you move to step 2 and you do it with confidence. You thank them for their time, hang up the phone, and you execute the exact same process we've spent this entire series detailing. The good news? It's 10 times easier the second time around. You already know what coverages you need. You already have your VINs and driver's license numbers handy. You know which websites to check. What took you a couple of hours the first time might only take you 30 minutes now. You are an educated, efficient comparison machine. And as you manage your policy year after year, you need to be aware of the life event triggers. These are moments in your life that should immediately make you think about your car insurance, regardless of where you are in your policy term. Getting married? That's a trigger. Married drivers are statistically safer, and adding a spouse to your policy can often result in a significant multi-policy and multi-driver discount. Buying a home? Trigger. Bundling your new home insurance with your auto insurance is one of the biggest and easiest discounts to get. Changing jobs? If your commute gets shorter, that's a trigger. Fewer miles driven means less risk, which should mean a lower premium. Did your credit score go up by 30 points? That's a huge trigger. In most states, your insurance score is heavily influenced by your credit score. A better score proves you're more responsible, and you deserve a better rate. Call your insurer and ask them to rerun your rates with your updated credit information. And the big one, adding a teenage driver. This will be a shock to your premium no matter what. But it's also the single most important time to shop around. The company that was cheapest for 2 middle-aged adults might be outrageously expensive for a family with a 16-year-old. Another company that specializes in family policies might offer a much more competitive rate. Never just add a teen to your existing policy without first comparing at least 3 other options. This is the ultimate mindset shift. Car insurance is not a static, fixed bill. It is a dynamic, manageable expense. It's a market, and you are a participant, not a passenger. The price you pay is a direct reflection of the effort you are willing to put in. We've covered a tremendous amount of ground. From understanding what a deck page is, to the difference between liability and collision, to using quote comparison tools, to negotiating with agents, and now to maintaining that great rate for the long haul. You are now more knowledgeable about this process than 99% of drivers on the road. You have the playbook. The anxiety and confusion that most people feel when they think about car insurance? That's gone. It's been replaced with a clear strategy and the confidence that comes with it. The power is now in your hands. But knowledge is only potential power. Action is what turns it into real savings, real money in your pocket that you can use for a vacation, to pay down debt, or to invest in your future. So here is your challenge. It's not just to like this video or subscribe to the channel, though we'd appreciate that. Your real challenge is to take action within the next 7 days. Use the steps we've outlined. Run your numbers. Get at least 3 quotes. See for yourself what's possible. And when you secure that new lower rate, I want you to do one more thing. Set that calendar reminder for 11 months from today. Title it, "Beat My Insurance Rate." Because the person who is most invested in your financial well-being, the person who will fight the hardest to keep your money in your pocket, isn't some faceless corporation. It's the person who's been listening to this right now. See you. Now go get the rate you deserve.